Hello everyone. Today let us discuss on the topic financial reporting and equity transactions. Financial reporting actually refers to the process of creating and disseminating financial statements and related information to various stakeholders including investors, creditors, regulators and the public. Next we will move on to the title Scope of Financial Reporting. Financial reporting helps in the following: it decision making, accountability, legal and regulatory compliance, market confidence, performance evaluation, resource allocation, benchmarking, and creditworthiness. Next, we will move on to equity transactions. Equity transactions in accounting refers to financial activities that involve the issuance, repurchase, or other changes in ownership interests in a company. These transactions are important for understanding a company's ownership structure, capital structure, and shareholder equity. Now, if you look at this picture, there is a glass of water. Now, from this picture, you can understand what is authorized capital and paid up capital. The authorized capital is nothing but that amount of money which the company is entitled to receive from the shareholders until its lifetime, whereas paid up capital is the required amount of money, that which is required at present point of time for carrying out all the activities. So this shows authorized capital is like the container that holds the water. It is the maximum amount of shares a company can issue. To increase the authorized share capital, a shareholder must get approval and payment of fee to the government is also required. But whereas in paid up capital it is like a water in the container. It is the amount of shares the company has issued to its shareholders. The company has the capacity to issue more shares up to the authorized capital of the company. The paid up capital can also be further classified into common stock and preferred stock. Common stock represents the capital contributed by shareholders in exchange for common shares. Stockholders have voting rights and may receive dividends and capital appreciation. Preferred stock. It represents the capital contributed by a shareholder in exchange for the preferred shares. Preferred stockholders have certain preferences over common stockholders, such as fixed dividend, payments, or priority in case of liquidation. Next, we will move on to retained earnings. Retained earnings is nothing but a portion of the company's net income that is retained and reinvested in the business instead of being distributed to shareholders as dividends. Retained earnings results in accumulation of profits and losses, source of capital, dividend distribution, reinvestment in the business, disclosure in the financial statements, and use for future growth. Next, we will move on to stock splits. Stock splits involve increasing the number of shares outstanding without changing the overall value of the shares held by shareholders. Both stock dividends and stock splits aims to adjust the number of shares outstanding while maintaining proportional ownership interest. Stock dividends involve the distribution of additional shares to existing shareholders as a form of dividend payment. Next, stock option. Stock option, it is a financial instrument that gives its owners the right but not the obligation to purchase a given asset at an agreed upon price and the date. Finally, we will see what is business consolidation and combination. Business consolidation refers to the combination of different business units or companies into a single larger organization. There are different types of business combination. One is horizontal combination, the other one is vertical combination, and the last one is lateral combination. Horizontal combination, which means you can combine any companies with different base. whereas vertical combination is combination of business companies with the same base, and lateral combination is a combination of both horizontal and vertical combination. Thank you.